This is the last video in this sniper course. In this video I will go over everything we've learned so far, and I will also touch on some extra key points I may have missed in the previous videos. I will also talk more about the signs you're looking for when trading on the 1 minute time frame, and I will also talk a little about hedging your trades. Overall, if you're trading the way I taught you in the swing course and in this sniper course, it doesn't matter what time frame you're trading, and it doesn't matter what assets you're trading. Whether it's Forex, crypto or stocks on the 1 minute or the weekly time frame. You'll see that all these patterns repeat on every single chart. The only difference is that whatever you see on the 1 hour time frame happens 60 times faster on the 1 minute time frame. There's 60 times more data for you to analyze. But you don't have to analyze every single candle. Don't waste your time. You should always do your main analysis on the 1 hour or the 15 minute before you even look at the 1 minute chart. And if you can't see any clear zones or your bias, go on the 4 hour chart. After your main analysis is done, only then you are allowed to go down into the 1 minute time frame. The 1 minute time frame should only be used for finding breaks in the microstructure and finding entries after you get your confirmation of price shifting directions. If you want to be a successful sniper trader, you have to constantly change between the smaller and the higher time frame, and you have to be lightning speed fast with your decision making. You can't hesitate and you can't overthink. As soon as you see the price action lining up for you to take the entry, you have to pull the trigger or you'll end up missing your prey. Then you'll see the price moving how you predicted, but you missed your trade and you start getting some negative thoughts. You start getting FOMO and you end up doing something stupid and blowing your account. You can't let yourself lose control. If that happens, just move on. There's trade opportunities every minute of every day. Enough of the talk, let's look at this GU chart again. When we entered these trades, we only expected the price to come down into this area of demand. When the price got to this point, you had a choice to make. Do you close the full trade and move on, or do you take partials and let the rest run? If you chose to let the rest run, how would you feel during this bullish move? Would you feel anxious because you just watched half of your profits disappear? Because if you did, you would probably end up closing the rest of your trade around this high without even getting any confirmation of price going any higher. That's what anxiety and overthinking does to you. It cuts out your rational thinking and makes you commit mistakes. Structure tells you everything you need to know. Don't listen to your inner voice whispering bad things in your ear. Listen to the story the structure tells you. This high was never taken out, and this rejection is your confirmation of continuation. You could have even found at least 2 more entries around this wick and this wick. Your next target was this low. Do you notice anything? Build up of volume and a change of character. If you're still holding your trades till this demand zone, do you cry about your profits disappearing, or do you look at this structure and decide to hedge your sell orders by opening buy orders after the price comes back to retest this area of demand? Now you have buys and sells open at the same time. No matter where the price goes, you'll end up in profit. Hedging is the only time I would allow you to move stops to break even. You don't want to be left holding the longs after the price continues to go with the bias. Remember, in the last video the price was around here, and I said after the price mitigated over 70% of the previous move and this area of supply, we are ready to continue with the bias. What happened? After this initial rejection, the price came up respecting something on the smaller time frame, giving you another opportunity to enter short, and now we're heading down, most likely below these lows. I will talk about hedging a little more at the end of the video, but for now, let's look at some 1 minute signs. This is the same gold chart from our previous videos. We have the price reached our supply zone. Naturally, we're now looking for a sign to short. Because as you know, price moves from zone to zone, so after this zone is mitigated, we're at least expecting the price to come down to mitigate a lower demand zone. So what's the sign? This lack of volume indicates bullish exhaustion and a potential reversal. This change of character signals a potential shift in structure. At this point you had 2 confirmations. On the 1 minute time frame, even one confirmation would be enough for us to enter a trade. So where do we enter? We have this order block sweep entry. We have this break and retest style entry. We have this liquidity sweep entry. We have another order block sweep entry after this break of structure. And after another break of structure and our final confirmation of price shifting directions. We have an entry after this break of structure. Let's count all the confirmation we had. 1, 2, 3, 4, 5, 6, 7. You literally had 7 signs of the price shifting towards a bearish bias. And you had 5 opportunities to enter based on everything I taught you in the earlier videos. Because this is gold, trading with a tiny stop loss is very risky just because it's so volatile, any little move can take you out. So in this case you could have easily entered all these trades with a stop loss above the high and you wouldn't even be close to getting taken out. But for the sake of this example, let's say you chose to have the smallest stop loss for each trade. Let me just mark the trades. Two of these trades got stopped out. And 3 of these trades literally had zero drawdown. Let's take these trades and see the risk to reward if you were to still hold them. Each one of them is running over 1 to 50 risk to reward. And it's only been just over 8 days of swing trading. And again, unless this high was taken out, you had no reason to close your trades. Let's go back for a minute. You also had the price come into our supply zone right here. Why didn't we look for shorts here? You did have a change of character here. But you also had a change of character here with an increase in volume. This indicates that the price is not ready to come down yet. Remember, every time the price respects something like this impulse move, it then comes back and mitigates the initial area in price which created that first impulse move. Just like here, this is a double confirmation of the price going higher. And even if you did try to short as the price was coming back into this high, there was never any confirmation for us to enter from. The first major confirmation we had was this break of structure. It is very important you always look for confirmations when trading on the 1-minute time frame. Usually the first major sign you're looking for is a change of character. Ideally, the volume should also support the change of character. In this case, the lack of volume. If the volume was increasing, we would expect the price to continue higher. Your next sign is multiple breaks of structure. Once you get your signs, you simply find an opportunity to enter. This eliminates all the thinking games, and you entering trades at random areas. Do you see how simple trading becomes if you know what you're looking for? This is another example. You have the price slowly coming up, building up liquidity that will eventually be taken out. The volume is decreasing, indicating a reversal. We get a major break of structure, which is our change of character, and the price comes back and takes out this order block. That's your entry number 1. Then you have another opportunity to enter around these two highs. And another opportunity at this high, which mitigated the previous area of supply. No matter if it's a 1-minute or 1-hour chart, the patterns and the signs are still the same. Now let's get back to hedging. Let's say you were in this short trade, targeting something much lower. Markets don't just move in one way, they move zone to zone. So naturally you're expecting the price to reverse at some point. This gives you an opportunity to hedge your trade and profit on both sides of the market. As a sniper trader, your risk to reward will often change from 30% down to 20% or 10% in a matter of hours or minutes. Hedging allows you to protect your account and keep your profit no matter which direction the price is going. Keep in mind, this is a very advanced way to manage your trades and should only be done if you have enough confidence in your trading abilities. Otherwise, it's a disaster waiting to happen. I'm not going to go into the details, but let's say you decided to hedge somewhere down here. What now? Nothing really changes for you. You still analyze the chart the same way. If you bought here, that means you had a reason to believe the price would come back to mitigate a major point in structure. Either here, or somewhere here. If at any point the price gives you a signal of reversal, you exit the buys and keep the sells. If however the price came down and gave you another buy confirmation, you exit the sells and keep the buys. There is no strict way to manage your hedge, and it's something you have to figure out on your own to match your trading style. But the overall idea doesn't change. If you get a sell signal, close your buys and maybe add to the sells. If you get a buy signal, close the sells and maybe add to the buys. There's not much else I can add here. This is it for the sniper course. I know it may have felt a little chaotic in some parts, but there's no easy way to explain all these concepts. I tried my best. If you have any questions, don't hesitate to send me a message on Instagram or Discord. I hope this course will turn you into the perfect sniper, and I wish you all the best in your trading journey.